In this briefing, we're going to break down the essential process of remitting payments to creditors. We'll be walking you through the key steps and best practices you need to manage these payments efficiently and, of course, ensure full compliance.
We've structured this into 4 logical stages. We'll start with the foundational step of gathering creditor information. Then we'll move on to the critical approval process for payments. After that, we'll dive into the mechanics of actually recording these transactions. And finally, we'll cover how to identify and manage any discrepancies that might pop up.
All right, let's begin with Section 1, collecting creditor information. Now, this first stage is really the foundation of the entire payment process. Getting the information right here is absolutely crucial for the success of every single step that follows.
So, first things first, what exactly is a creditor? Well, to put it simply, it's any person or any business that your organization owes money to. This is for goods or services you've already received. Understanding this relationship is fundamental to managing your accounts payable correctly. So, for every creditor, you need a checklist of essential information on file. And this goes way beyond just a name and address. You need their specific bank details, like the bank, account number, and BSB, to make sure the payment actually goes to the right place. Just as important are the agreed-upon payment terms, which of course dictate when you pay, and their preferred method, which dictates how you pay. Getting this right from the start prevents a world of delays and errors down the line.
Now, to keep everything accurate, the procedure lays out a really straightforward 3-step process. First, you identify the exact payment method. Second, you record that payment within your accounting software, Xero for example. And third, and this is critical, you must verify your entry against the source documents to ensure everything lines up perfectly.
To make sure that data stays clean and reliable, this checklist is absolutely key. It's not just about manually double-checking numbers either. It's about using the automated tools built into your software to help catch errors. It's about following a consistent data entry process across the entire team. And of course, it's about making sure all your practices adhere to the guidelines set by the Australian Accounting Standards Board, or AASB, which governs financial reporting here in Australia.
All right, let's move on to our second section, authorizing creditor payments. Now that we have the correct creditor information established, we can look at the formal procedures for getting a payment approved and then executed.
Before any payment gets the green light, you've got to have all the necessary paperwork lined up and in order. This means matching the supplier's invoice, that's the bill, with the original purchase order, which was the initial agreement, and the delivery note, which is your proof that the goods or services were actually received as expected.
So what you're seeing here is a typical approval workflow. It starts with an employee who initiates the payment request. From there, it moves up to a manager for review and formal approval. It's only after that second set of eyes is signed off that the finance department can actually process the payment. This separation of duties is a crucial system of checks and balances. It helps prevent errors and, just as importantly, it mitigates the risk of fraud.
Okay, so once a payment is fully authorized, the next step is to get it recorded. This involves entering the payment details into your system, and this part is key, linking that transaction directly to the specific invoice it covers. The accounting system then automatically updates your general ledger, which creates a clear audit trail. The final step is to generate reports, so you can monitor and review all your outgoing payments.
And I really need to stress this point. Sticking to your organization's policies throughout this authorization process is absolutely mandatory. It's not negotiable. These policies aren't just about procedure. They're a primary control for making sure payments are handled correctly and for protecting the company from financial risk.
All right, on to Section 3. This is where we get right to the heart of financial record keeping, entering payment journal entries. This is the core function where we create the official, permanent record of a financial transaction.
So, what is a journal entry? Well, it's the official record of any financial transaction. And a fundamental principle of accounting is that every single entry has to have 2 sides, a debit to one account and a corresponding credit to another. Let's make this real with a simple example. Let's say the company buys $100 worth of office supplies. The value of its supplies, which is an asset, goes up. So we debit the office supplies account for $100. At the same time, its cash, which is another asset, goes down. So we credit the cash account for $100. This is the whole idea behind double entry bookkeeping. Every transaction has 2 equal and opposite effects. So to keep this straight in your head, here's the rule of thumb. You use debits to show an increase in an asset or an expense. On the flip side, you use credits to show an increase in a liability or an equity. Understanding that distinction is absolutely essential for making correct journal entries.
Now, if you're using software like Xero, the process itself is very straightforward. You'd start by navigating to the Manual Journals section. From there, you create a new journal, you add the date and a clear description or narration, and then you enter your debit account and amount and your credit account and amount. Once you post it, that entry is officially recorded in your ledger.
But before you post that entry, there is one final critical step: verification. You have to make sure your total debits equal your total credits. This simple balancing check is the foundation of accurate bookkeeping, and it's what ensures you remain compliant with accounting standards.
And that brings us to our final section: what to do when things don't go according to plan. Here, we'll cover how to manage financial discrepancies, how to spot them, how to fix them, and importantly, when a problem needs to be escalated.
And really, the importance of this just can't be overstated. Accurate financial records are absolutely essential. They're critical for making sound business decisions, for staying compliant with legal and regulatory requirements, and for maintaining the trust of everyone with a stake in the organization, from your investors right through to your employees.
So, what kinds of errors should you be looking out for? Well, there are several common ones. It could be a simple typographical error, like an extra zero that accidentally turns a $1,000 payment into a $10,000 one. You might also find missing transactions that understate your expenses, or even duplicate entries that cause you to overpay. Other common issues include incorrect amounts or transactions that are misclassified into the wrong account, which can distort your entire financial picture.
So what happens when you find a discrepancy you can't resolve on your own? Well, there's a formal protocol you must follow. First, clearly identify the problem and double-check all the related documents. Next, you need to record the specific details of that discrepancy. Then you notify your supervisor. And finally, you have to follow up to make sure the issue is fully and finally resolved.
And if you look at real-world case studies, you can really see the impact of these errors. A misplaced decimal point can turn a minor expense into a major liability. A duplicate invoice can lead to paying for the exact same service twice. In every case, the guidelines are crystal clear. Prompt identification and correction are paramount to maintaining financial integrity.
Now, this word cloud you're seeing gives you a great visual summary of the core ideas we've covered today. You can see how terms like payment, creditor, invoice, account, records, and accurate really stand out, which just reinforces how central they are to this entire process.
So, we'll leave you with this final thought to consider. How does the procedural rigor in your day-to-day payment processing directly impact your organization's overall financial integrity and its ability to make strategic decisions for the future? As we've seen throughout this briefing, the connection is direct and it is significant. Thank you for your attention.